the decision day today in Nigeria. For the 301 time here in Nigeria, we'll get the decision that will be running and determining the rates in the country. That is our major focus on this episode of Business Incorporated. You're welcome. I'm Ini John Mekwa. But first, let's start with some of our usual, and we're starting from the global space that oil prices declined for a third consecutive session on Tuesday on concerns that brewing trade war between major crude consumers, the United States and European Union, will curb fuel demand growth by reducing economic activity. We look at the board and then we see what's happening at this time. It's a 0.91% drop in the price of Brent, bringing that price to $68.58 a barrel. WTI is also down almost the same percentage at $66.54 a barrel. The Trump administration has set an August 1 deadline for countries to secure trade deals or face steep tariffs. While the EU is exploring a broader set of possible countermeasures against the United States as prospects for an acceptable trade agreement with Washington fade. This is according to EU diplomat. The U.S. has threatened to impose a 30% tariff on EU imports if a deal is not reached by then. A weaker dollar has limited some losses for crude as buyers are using other currencies and paying relatively less. Prices have slipped as trade war concerns offset the support by a softer U.S. dollar. This is the observations by traders. And in Nigeria, the Nigerian National Petroleum Company Limited says it has generated a total revenue of 4.571 trillion naira in June 2025, sustaining its upward earnings momentum as crude oil and gas production recorded notable increases. This is according to latest data from the Nigerian National Oil Company. This is part of the NNPCL's monthly report summary for June that was released and shows that there's a steady rebound in upstream activities with daily crude oil and condensate production rising to 1.68 million barrels per day. That's the highest since January. The report also shows a robust performance in gas output, with natural gas production hitting 7.581 billion standard cubic feet every day in June. That's up from 7.35 billion in May and 6.61 in February. It indicates a sustained recovery in Nigeria's gas sector. A breakdown of key metrics show that NNPCL posted 905 billion in profit after tax for the period, while cumulative statutory payment to the Federation stood from January to May stood at 6.961 trillion naira, reinforcing the firm's critical role in national revenue generation. Let's see what's happening in metals. Gold eased on Tuesday as investors booked profits after prices scaled a 5-week high, while market participants are focusing on trade talks ahead of the U.S. President Donald Trump's August 1 deadline. Look at the numbers. It's down. It's a red color for most of it this afternoon. Spot gold is down 0.3%, $3,385.20. U.S. gold is also down 0.3%, $3,396.10. Spot silver also down, same value, 38.74 per ounce. And platinum is down 0.4%, $1,433.20. Palladium is down much more than that, 1.8% at $1,242.54. Well, gold prices edge lower amid profit booking, but has remained close to the 5-week high due to lingering uncertainty ahead of that August 1 deadline, which is on everyone's lips. Now, the U.S. dollar index steadied against its rivals. A stronger dollar makes greenback price gold more expensive. And then away from that, the Nigerian Civil Aviation Authority has announced that domestic airlines refund 1.03 billion to 5,285 passengers between April and June. The sizable payouts reflect increase in the amount and the enforcement of Part 19 of the NCAA's 2023 regulations that's aimed at protecting passengers affected by flight cancellation or delays. The authority did not specify individual airlines or routes. It emphasized that refunds or alternative flight options are mandatory, especially when airlines do not provide at least 24 hours notice. Now, the newly released rebased GDP is still in the news, and according to that, we saw that from the National Bureau of Statistics, real estate has risen to become Nigeria's third largest economic sector, contributing 10.78 of real GDP and surpassing crude oil, which now accounts for 5.85. While this signals a structural shift and reflects improved capture of informal housing and property activities, veteran economist Dr. Bismarck Ruani emphasizes that oil remains critical to foreign exchange inflows, underpinning Nigeria's hard currency revenue base. His remarks highlighted despite real estate growth on paper, Nigeria's external earnings continue to rely heavily on oil sector. Was a guest on Business Morning earlier today.
In terms of contribution, it depends on how you measure it. But real estate will not generate dollars for it. Oil and gas will generate dollars. So at the end of the day, you need a currency, you need to earn foreign currency, to defend your own domestic currency, to add values. And real estate is cyclical. In other words, is that during boom times, real estate values increase, but during times of downturns, the real estate values actually decline sharply. So it is one of those sectors, because of the housing deficit you have and all of that, that can drive growth, but it's not the only sector. It's necessary to have a real estate sector that is booming, but it's not sufficient. You need a combination of all of these factors, the ones that employ people, the ones that house people, the ones that generate logistics and better roads, better ports. So it's a whole cocktail of things that you require to achieve, for people to feel that their standard of living has improved. What is happening today is that the standard of living of Nigerians today is much worse than it was maybe 15 years ago. So you've laid the foundation for growth, but you now have to ensure that that growth is sustainable, is inclusive, and also that the dividends of this growth is distributed in such a way that no particular section of the country, no group in the country, no area in the country, no region in the country is left behind.
Well, adding a fiscal dimension to the discourse, Mr. Taiwo Oyedele, chairman of the Presidential Fiscal Policy and Tax Reforms Committee, is cautioning that revised GDP figures should not become a rationale for increased government borrowing. Mr. Oyedele emphasizes that a larger GDP base doesn't equate to greater fiscal space. He's asking authorities to maintain prudent debt management as part of ongoing fiscal reforms.
Based GDP for the country gives more insights and more accurate data for policy formulation. For example, we now know that the agri sector is not growing enough. So the growth is, I think, 0.7%, less than 1%. If your population is growing at about 3% and your agri is growing at less than 1%, then you can predict what that means for food security and even the prices of those foods. You also have the problem with moving food and other produce around, and the multiplicity of taxes you have to pay, and so on and so forth. On one hand as well, our tax to GDP ratio will fall because the size of the GDP has gone up, and your tax revenue will not go up overnight. It will take time. So there will be slight downward review to the tax to GDP ratio, because some of the things we have introduced for the first time in Nigeria, many of those things have been done in those countries for years. So they have learned a lot. They have made mistakes. We don't need to repeat their mistakes. We can just learn from them and then leapfrog from there. So that's the way we're going about it. We're very confident that states are on board with us and they will be ready to implement the reforms.
And because it's a special edition of Business Incorporated, we head straight to Berlin now and see what's happening, beginning with the European market. We have Emily Lashler joining us. Hi, Emily. Good afternoon. Welcome to the program. The big thing now is no longer US-China. It's now EU and the US. I wonder how this is affecting European stocks and trading at this time.
Hi, good afternoon. Thanks for having me. Well, it's very clear that investors are still a little bit wary, and that's why shares were slightly down this morning. There's still a lot of anxiety around what's going to happen with the U.S. and EU trade deal. The deadline for a deal to be made is August 1st, so it's quickly approaching, and the markets are reflecting that. So shares were down a bit this morning. French lab supplies manufacturer Sartorius Stadium Biotech slipped nearly 7% after posting its second quarter results. European chemical stocks were also down. The one exception of a stock that was doing well was British catering firm Compass Group. They gained 4.5%, and that was after they agreed to buy the European food service business Fermat Group for 1.5 billion euro. But aside from this kind of outlier, it's clear that investors are still feeling very, very anxious ahead of the trade deal, and they're keeping an eye on second quarter corporate results that we can expect throughout this week.
All right, moving to other issues now. There was a meeting with the German Chancellor on an alliance of top German companies. They pledged to invest more than 630 billion euro in the country over the next 3 years. What would you say motivated this, and what else should we know about it?
That's true. Chancellor Merz met with executives from more than 30 of Germany's top companies, and this was in an effort to revitalize Germany's economy, which, for the past 2 years has been in a recession, and the year before that was stagnant. So, Germany's infrastructure is crumbling. This is due to more than a decade of austerity measures. So fixing it, investing in its future was a key focus for Merz and the business leaders at this meeting. That's why they gathered. And the companies included more than a dozen that are listed on the DAX, that's Germany's main stock index. And they discussed what would be needed over the next few years. So companies like Siemens and Deutsche Bank, they came together, united under an umbrella that they called Made in Germany initiative. And they've all decided to pledge collectively 631 billion euro over the next few years in Germany. And the Made in Germany initiative is a nod, of course, to Germany's, the name of it is a nod to Germany's reputation, as a manufacturing powerhouse, a reputation that has really fizzled, over the past few years. That's because a lot of the production has moved abroad or has been seriously crippled by rising labor and energy costs here.
But how does all of this fit into Merz's agenda?
Well, fixing Germany's economy is really, really central to Merz's agenda in office. I mean, this initiative is just one of a series of steps that Berlin has taken to pull the economy out of this rut. For example, back in March, Berlin announced billions of euro in tax relief and a 500 billion euro funding package for infrastructure projects, one of which is Germany's national rail network, Deutsche Bahn. It has an infamous reputation here for being chronically delayed. It's in desperate need of workers as well. Last year, it posted a debt of 2.7 billion euro. That's just to give you an idea of how much it's struggling. And it's an integral part of daily life for Germans, and it's falling apart. So that public funding package is going to help keep infrastructure running. But the meeting was really so that German businesses could get together and plan private investment, because we need to go beyond just public investment to keep the lights on. We need to build infrastructure that is future-proof in this country. Just to give you one final small example, Merz's other key priority, aside from fixing the economy, is bolstering Germany's military and defense. This is amid the backdrop of Russian aggression. But when you can't move tanks because your rail network and your bridges cannot support the weight, then that's a problem. And you also have to remember that, the German economy has virtually seen no growth since 2019, since before the pandemic. So there's really some disagreement as to whether the GDP will rise this year, will expand this year. So we'll just have to see if this combination of public and private investment can spur the growth that Germany really needs over the next 3 years or the next 10 years or so.
All right, thank you so much for that, Emily. And of course, we'll stay on these stories in the days to come.
Thank you.
Now let's see what's happening, not with the markets now, but to see preparing our conversation for MPC's decision that to be announced soon, we hope. But let's see what's happening in our neighboring countries, in some of those countries in West Africa and other parts of the continent, what they've been doing with their rates decision and how it's been affecting their inflation and all. And we have Willie Bong for that. Hi, Will.
Hi, Ine. How you doing? So let's just jump right into it, talking about what most economies in West Africa right now is with caution, and we see that hold policy, and we see that cautious optimism that inflation is going to ease all through the second half of 2025. Oh, that's why we see that stance from most of the central banks, and that's what we're going to look right into right now. Starting with Ghana. Ghana's monetary policy right now reflects cautious optimism, as I mentioned. Inflation fell to 13.7% in June, that's last month, 2025, and that's the lowest level since 2021. And that marks the sixth consecutive monthly drop. In May, we also saw the Bank of Ghana maintaining its policy rate, that's the interest rate at 28%, keeping a tight stance even as price pressures seems to be moderating, but an emergency MPC meeting was convened in mid-July. We saw that to review economic developments. Though we saw no rate change, none was announced, signaling readiness by the central bank to adapt if needed. Now, the central bank also appears to be poised to balance its inflation fighting discipline with support for economic recovery as it prepares for the regular MPC session, and that's at the end of this month, July. Let's look at South Africa now. Same policy shift, but in terms of easing, it's shifting towards easing at the moment. That's where the monetary policy direction is. On May the 29th this year, we saw the South African Reserve Bank cut the repo rate by 25 basis points to 7.25%, looking at that on the screen. And also, that's marked a policy pivot aimed at aligning inflation expectations towards 3%, but they had 2.8% in May. That's projected to be a 3%. But at this point right now, a headline CPI inflation stood at 2.8% in May, and that's remaining below the central bank's lower threshold of 3%. As I mentioned, that's the target. They want to get below that. But with growth outlook downgraded, the South African Reserve Bank seems determined to support economic momentum while keeping inflation anchored. Now, the next rate decision is scheduled for July, expecting continued cautious easing. Let's jump in now and see how Kenya, markets that we track, economies we track. Kenya has continued its rate cutting cycle, and this is amid controlled inflation. On June the 10th, we saw that central 5%, and marking the sixth consecutive reduction since August 2024. This easing move, we all know, was motivated by inflation moderating within the target bounds. We see it within 2.5 to 7.5%. That's stable. Well within that target range. The decision, however, reflects a strategy to stimulate private sector lending as the economic activity seems to be recovering. And the MPC is expected to meet again in August this year, where the balance between sustained easing and inflation vigilance will be evaluated. I hope we'll see more easing in terms of inflation. Let's look at Angola now. See, the monetary stance remains firmly restrictive. As of June 2025, annual inflation rate was held at 19.5%. We see inflation also at 19.73%. That's slightly down from May's 20.74%. And the National Bank of Angola has maintained its key interest rate at 19.5%. That's since May 2024, making July's meeting the seventh consecutive hold that they've had now. And the policy stance aims to rein in inflation. We all know that. That's the key plan of the central bank right now, although a high borrowing cost continues to burden economic revival efforts. And our experts are expecting that the next MPC meeting on September, that's 18 to 19 this year, much later this year, is going to decide whether the unchanged rates will persist into late 2025. Inflation, however, remains the central risk factor for most of these central banks. Now, coming home back to Nigeria, we see economy is navigating a very delicate balance here. We just had that GDP report, we had inflation report, and this, as I said, is amid persistent inflation and interest rate stability. Now, in June 2025, headline inflation eased to 22.22%. That's what we have there, 22.22% year on year in June, and that's marking a third consecutive monthly decline. Although we see a continued or persistent food inflation, it remains elevated. But meanwhile, the Central Bank of Nigeria has held the interest rate steady at 27.5% since its February meeting this year, citing improved macroeconomic signals. But we saw recently the central bank governor, Olayemi Cardoso, warning that FAC liquidity the surge in FAC liquidity may trigger inflation. But that's something we'll keep an eye on. And the MPC meeting today is expected to reassess price pressures and determine whether further action is needed. But despite these divergent inflation trajectories we've seen for most central banks across these economies, they've adopted broadly the same approaches: tight policy until inflation shows sustainable falls, and this is followed by gradual easing or cautious holding aligned with macroeconomic signals. Now, specifically, we see inflation anchoring policy decisions. That's inflation remaining elevated. We see that in Nigeria, we see that in Ghana, Angola. Policy rates also remain high, to re-anchor expectations. Now, easing only begins as inflation normalizes. We see South Africa and Kenya has commenced modest cuts once inflation was within or near the target bands that the central bank is looking at. Now, we're not forgetting external vulnerabilities. The external shocks are shaping the tight stance. We see trade tariffs are also seeping in right now. Central banks are keeping an eye on it to see how it affects Africa. Now, dependence on commodity exports and volatility in currencies are leading to this precautionary conservatism that they are taking, especially in Nigeria and Angola. And policy coordination also remains limited. We're not saying there's no unified regional framework at the moment, but spillovers through shared economic channels. You see that oil prices, we have most of African countries that have that in common. Currency pressures, we know, dependence on the dollar. These are evident factors that central banks are looking at. But in summary, these countries, they're exhibiting this monetary policy convergence, high rates to fight inflation, slow adjustment cycles, and that keen sensitivity to fiscal and FX fragility. But hopefully in Nigeria, we've seen that stability in foreign exchange. The naira has been relatively stable against the dollar. We hope that at the end of the meeting today, while the CBN governor is going to give his verdict, we're going to be expecting possibly maybe a hold, maybe a cut. But really, I don't know. What are you expecting? Because a lot of people will say, a conversation I had in capital market, the guest analyst said he was not expecting a cut, that it'd be too soon for Nigeria to start cutting rates, that we should hold on for a while. Let's see how these external shocks are going to impact the economy before we start saying, yippee, inflation is reduced in 3 consecutive months. But others are expecting a 25 basis cut. Some analysts are expecting that. But if we continue to see, if the rates are going to be cut, we're going to continue to see a decline in the fixed income yields for fixed income, because the monetary policy rate is going to determine yield direction for markets, and that's where markets are possibly pricing in maybe a 25 basis cut or a hold stance.
Yeah, well, like as you said, well, there are 2 groups of people I've also spoken to. There's a group that's looking forward to, not necessarily expecting a 25 basis points cut. And there's the other group who say that it might be too soon to start cutting because there's still a lot of volatility and all of that. And if you notice the inflation numbers, so we've seen headline inflation decline, but when you look at core inflation or food inflation, it's not looking so
elevated,
good.
yes,
so look beyond the top, or, you know,
and look at the
exactly
indexes,
because I mean those are the drivers of it. But I mean, these are the factors that the MPC obviously have been considering since yesterday, and today we will hear what the result of their consideration is. And we'll also have some guests in the studio. I'm sure they will also try to predict the decision before.
Can't wait for this conversation. It's going to be very interesting morning.
I know, right? Especially with what the CBN governor has brought up, the fact or the impact of FAC on inflation. That's also another interesting one. I really would like to hear what our guests will say about that. But thank you so much, Will, for taking us round. So, yes, we're going to start from there, talking about what the governor of CBN, Mr. Cardoso, said, noting that FAC is feeding into inflation numbers. Why should that be? Well, we'll try to find out what our guests think about that. As after the break, it's a special edition of Business Incorporated. We call it Business Incorporated Special because we're incorporating the CBN's MPC meeting and then the decision, the announcement of the decision. And then we'll try to explore some of it and what to expect from it right here on the program. But that's after the break. Please stay with us. It's MPC Decision Day here in Nigeria. You're welcome to the program, Business Incorporated Special, where we capture the live feed from what's going on at the CBN headquarters as the MPC members of the meeting end their conversations behind closed doors and come up to make that announcement. So while we wait for that, we're right here in the studio to look at some of the factors that they may have considered or may be considering at this time. And right here in the studio, we have the Chief Executive Officer of Center for Promotion of Private Enterprise, Dr. Muda Yusuf. Dr. Yusuf, good to have you. Welcome to the program.
Thank you very much.
We also have right here in the studio, Treasurer at FSDH Merchant Bank Limited, Mr. Jamiu Kuku. You're welcome to the program, Mr. Kuku.
Thank you.
And joining us virtually is Chief Economist, SPM Professionals, Paul Alaje, joins us virtually from Ibadan. Mr. Alaje, good afternoon and welcome to the program.
Thank you so very much for having me. A beautiful afternoon to you and the co-panelists with you in Lagos.
Thank you. So let's start with you, Mr. Laji. And I'm starting with this because it's one of the latest things that CBN governor has talked about recently. His fears of the impact of FAC payment into inflation, because obviously the decision of the MPC is based majorly on what inflation numbers are telling us. And he is worried of the negative impact that FAC is having on inflation.
Now, FAC have a number of impact on Nigerian inflation. One of those is injection of liquidity into the economy. It's not necessarily wrong that you have injection of liquidity in the economy. What really leads to major concerns or issue is, number one, what is the money spent on? When you look at how subnational and the entirety of government has spent money over the years, based on the numbers available, you see that this is already causing demand pull inflation. And this has been the practice over the years in Nigeria, as we have seen demand pull inflation. Yes, money must be injected to the economy, but how is this money spent? Another one is spending that induces inflation by subnational, for instance, by converting Naira into FX, which may include dollar, euro, as the case may be. So when you say that the central bank governor says he has some concern, it's a valid concern that over the years we have noted. And you can see them in this way. Number one is liquidity surge from FAC. This we call demand pull inflation. FX conversion by state will also lead to pressure on the Naira, even though now we have relative stability. Then you have the level of spending, which may aggressively cause subnational to have some kind of inflation coming from there. But by the time we aggregate inflation, because if you read the National Bureau of Statistics, where they disaggregate some of these reports, is that some states have more than the other. And this is why over time we have mentioned that it's important for us to have policy convergence between fiscal and monetary authority so that we can have a direction. As much as monetary authority wants to have control of inflation, to bring inflation perhaps down to 15% as promised in the beginning of the year, or to what is allowable by this nation, the style of economy we have, which is 6 to 9%. But if we keep putting more funds we are having more funds going from the fiscal side via what do we call it now? Via FAC. The truth is that inflation may surge. And when that surge happens, people will be finding it difficult for their disposable income to buy things that are meaningful. And of course, businesses and household, not just individual household businesses, they will always find it essentially very, very difficult to do. So he has a genuine concern, and because this is what is happening this moment today.
So, I mean, it's, it's not a bad thing, as you noted. FAC should be paid because that's what's supposed to be used for development. And I think you said two things. Depends on what is being spent for and also the demand it makes on FX. Is it normal or is it just a Nigerian thing? You know, because I mean, I'm sure other countries, they also have their own system. Does it necessarily have to pull inflation, or are there ways to manage it?
Inflation will remain with us for long. Even though we conquer this inflation, it will be winning the crisis. We might have not won the war until we essentially change our system and pattern of spend. And I'll quickly say the reason why I made that remark. One is, how do we budget? Our budget cycle, we all talk about the federal government, which I also think should change at the federal government. 70% on recurrent expenditure is absurd. Apart from Lagos State, and I may want to examine about 2 or 3 states in recent time, 70 and I'm being charitable with 70% on recurrent. Some states spend as high as 80% on recurrent expenditure. We cannot say that with 80, 70, or 60% on recurrent expenditure, with inflationary pressure, goodbye. What built nation from Europe to the Middle East to Asia, countries that have developed have concentrated not less than 50, in some cases 60, 70% of their spending have gone directly into capital expenditure and, most importantly, in supporting private sector to build technology. This is not what we are seeing. Nigeria at least have approximately 37 subnational. But how is the money spent among these subnational? Apart from Lagos, we have seen recent development in the FCT. Most of other states, and I say more than 30 of those states, still have a larger proportion of their monies going into recurrent expenditure. And what you cannot debate is that perhaps there are some conversion going on. In 2023 to 2024, the central bank governor also made some comment. They are worried because as soon as fact is shared, we saw surge in exchange rates that Naira gets weakened. Although we have seen some relative stability around 1,005, 1,006 in recent time, but my fear is that in a matter of months, political activity will start. Are we going to go back to Egypt of still spending dollars to delegate and using those to canvass? Where will these dollars come from? Perhaps that is what subnational and those who want to hold on to power are looking at this moment today, hoping that when the time comes to retain their seat at maybe National Assembly, State Assembly, the state governor, and so on and so forth, we will not say the gains that we have made in spite of the pain that policies are brought, the gains that come with it, are we not going to jettison them? Are we not going to throw them away for us to start all over again? That is not my prayer. That is not my wish. And I hope that will not be what we'll see after the election in 2027.
Well, we hope so. Dr. Yusuf, I mean, you heard what Mr. Laje said. It seems the politicians are not helping us in this regard. And he just painted a picture of political activities and the issue of using dollars, FX, you know what I'm talking about, for politics, and what that could do to this relatively stable Naira we've had in a couple of months. We're coming from FAC, but he just brought in the political side of it, which is even, more fearful to us. Yeah. But is there no way to escape this? Let's use Naira and do the politics. Wouldn't that help our situation?
Of course, of course. I think we need to be a lot more creative in managing our fiscal operations, because we are in an age of technology. If there is a release of FAC, there should be a way to track how the FAC is spent. Because the most troubling aspect of this is not so much about whether they are using the money to pay arrears of salary or pensions or building roads or things like that. I think it is more about the money laundering component, of the FAC allocation. Because this component finds its way directly into the FX market, especially through the BDCs and all of that. a whole lot of things happen there. So it comes back to the issue of transparency in governance, transparency in the management of public finances. You know, for me, I think that is the more critical aspect of it, because even if you spend on capital, ultimately, for instance, if we are importing machineries, equipment, it will still, you know, come to put some pressure on the FX market, you know. But what is more important is to ensure that this kind of money, I mean, this factoring doesn't go directly to hit the FX markets through the money laundering process. I think that is the most, and this is more about dealing with the issue of corruption in the public space, issues of the quality of government spending. You know, that's a very big issue. And it's an issue that occurs at practically all levels of government. So we have to face that reality, to hold our leaders accountable, to ensure that whatever money is in their custody are spent for the purposes of supporting productivity in the economy and all of that. No doubt it will create some money supply issues, no doubt, even if we spend it legitimately. But it will be worse with a money laundering issue, where people prefer to keep whatever they're able to get in dollars than
But I wonder who's going to check
this.
this, because we're talking of governments now. Government make the rules. They're supposed to enforce the rules. You know, I know you mentioned the people. Perhaps is that where the saving grace is? Can the people push the government to be more transparent and reduce this money laundering?
It's an accountability issue. You know, one of the weaknesses we have in our democracy is the very weak citizen participation. Because for most of us who are citizens, once we vote, that is the end of it. We wait until the next election. So, I mean, we should wake up to holding leaders accountable. We should not just leave it to a few civil society organizations. As citizens, I mean, we have representatives at the local government level. We have representatives at the state level. We have representatives at the federal level. So perhaps our democracy has not evolved to that level, but we should begin to activate that.
Mr. Ruwani said this morning that, you know, it's the middle class, because the poor people are busy trying to get what to eat. So I guess it's people like you.
Even some of the middle class are struggling to meet their bills these days, you know. So it's an issue, really. It's an issue, and it's a very big issue. There's no doubt about that.
Mr. Kuku, what are your thoughts about this observation from the CBN governor, and perhaps how we can handle it?
Okay, thank you so much. So for me, the first point I would say, I would agree with the last speaker. So in terms of fact, it's a money supply issue. I mean, if we continue to track it, why people would prefer to play in the FX markets is really because it will shield our identity. If people have liquidity, you can procure or get FX, and it will kind of, in a way, shield the identity, and people want FX. But again, I agree that on the current accounts, that has more impact on inflation. It has a high influence on inflation. Like I said, if you're allocating that into capital projects, it's going to be a one-off expense. If you're buying equipment and all that, it's not going to repeat. So we need to have like a structure around that, because we all know the sum. And we know what inflation is. If liquidity is not getting productive capacity, price would increase, and that's what we call inflation. So that money at every point in time, we need to always try to direct it into things that will be productive. It's telling on the scorecard that people are not doing anything. Because if money is coming out and you're actually putting it to use, there won't be that slack that will start to push prices. So I think we need to accountability, and also we need to be accountable, and I'll say efficiency around utilization of liquidity. At the end of the day, the slack is what ends up as inflation. So I think that needs to be addressed. And on the part of people, that's what we have. We have all these people to also, for accountability purposes, to call the people to question that how have we been utilizing these funds. I agree, maybe in the participation of the democracy at the onset, maybe a lot of people don't really look at the candidates they want to put up for positions. I think that should also improve. But aside that, Economically, we are not at that. We don't have that level of economic puberty yet to be independent. So we still need a lot of guidance around how we operate. I mean,
And you know, one thing that you said that sticks out for me is if the funds are being used productively, we would not have the issue of inflation. And in so many states, you do have projects and potentials that we keep talking about in agriculture, in natural resources, which if these funds were pushed into, would actually generate a lot of economic activity. And I believe we'll not have the issue of the fallow or lazy funds that is a problem to us at this stage.
Exactly. There is always an equilibrium economic equation, which is supply-demand dynamics. Once there's a slack in that, you will find that either giving you results like inflation and those kind of things. So we need to try to balance that and just make that equilibrium always happen.
And those things are also important, especially now that we are going into a new environment of tax regime. Now, we have a tax reform. And one of the key objectives is that it's going to boost government revenue. There is no doubt about it, even though Thai will often place down that aspect of it. But it's clear that it's going to increase government revenue. What happens when government revenue increases? So as we even engage on this tax reform, we should be thinking ahead. If government revenue increases, what happens? Because if you come through this cycle again, then the economy may be worse for it. Because what we are beginning to see now is that the more money is available in the public space, public sector space, the higher the level of this corruption, these leakages, and these frivolous spendings, you know? So I think collectively, we should be thinking ahead of it. Because when you have a situation where you are moving resources from the private sector, from the citizens, which is, in a sense, what taxes also means, into the public space, for the purpose of either redistribution or for the purposes of spending to ease the pressure on the citizens. And it doesn't happen that way. It's going to be another major issue.
I think that's one of the questions I asked Mr. Ayodele, because he incidentally was on the program this morning on Business Morning, and I asked him, so we've seen a new VAT formula where the local government is getting more now. I think they're going to about 35, states 55, and less for the federal government. It's a good thing. We're fighting for local government autonomy. They are closest to the people. But then what? Then they have these resources, and then what? Then they have the autonomy, and then what? I asked him, I hope there's also something in the system, you understand, that also holds this, you know, to accountable. I think it rests more from his response that he gave me. It rests more on the people. No, if it will become more participatory in our governance, I guess, I think that's where he actually led to.
Yeah. It's beyond him, actually. His own responsibility is to come out with a framework to mobilize the resources. How the resources are spent is completely beyond him. And that is why we need to sound the alarm ahead, that we need to see a lot more. Because one of the challenges we have, even with the current reforms, is that, yes, we have seen the subsidy convergence. These two reforms have boosted revenue.
We saw 1.8 trillion for the month of June.
The question is, what has now happened? Because the resources have been transferred, you know, as it were. What has now happened in terms of giving back? So it's a very, very critical question, you know, which could also create challenges, you know, for governors if we don't address it. You know, it's something that we
And I think these are the issues when we had protests in a country like Kenya, you know, the tax reform and all of that, because as the picture you painted now, the funds go from the private sector to the public, and the public sector is actually supposed to use that for maybe mostly facilities that will help the private sector make even more
ease
funds.
their pressure, reduce their spending.
We're talking of power, we're still talking of road infrastructure.
Health, you know, water supply.
Exactly.
You know, these are things that citizens spend a whole lot of their budget on. So if the government can take that burden away from the citizens, yes, we know that, yes, something something is happening. Or even we can reduce some of these our tariffs. I mean, you pay import duty on this, import duty on that. If you can reduce that, you leave more money with the private sector. You leave more money with the investors. You leave more money in the pockets of the average Nigerian. You know, those things have a way of boosting what you call utility, you know, in economics. Utility at the individual level, which also, you know, influences, affects the welfare of the people.
Purchasing power.
Yeah.
So, I mean, inflation is at the bottom of this or at the middle of all of it. So we see there inflation is at 22.22%. And that's the third drop we've had. But food inflation is not looking so good, as well as core inflation, which is why a lot of people believe that the MPC shouldn't be in a hurry, you know, to cut rate. But apart from this number, there are perceptions too. And this data is also from the Central Bank of Nigeria. The business and household inflation perception. There you have it. So for June, we saw that perception was high, public perception of inflation. So while we are celebrating the numbers that inflation has dropped and all, for members of the public, it's high. And they put it about 71% for June. But that's better than what it was in May. In May, it was about 75%, 75.3%. Moderate perception of inflation, you had about 20.9% population of the population tested here saying that inflation was at moderate. While those who think it's low, maybe these are the very rich guys, it's just about 8% for the month of June. It was lower in May, so 6.5. Household high perspective is 69, lower than what it was in May, while business high perspective is 72, just a bit lower, a bit higher than what it was in May, and we know, of course, official inflation. So let me come to you, Mr. Kuku. The perception of inflation versus the numbers that we get from NBS. And the difference seems to be so much. It seems to be so much. Is it the parameter that's the problem? Is it the area of focus? Or what do you think?
Okay. I agree with you. I think what we should start really is how did we get these inflation numbers? We did some recalibration and we saw it drop from, I think, 33 levels that it was to about 24. So to the man on the street, who was having a contact to reality, he hasn't really felt the impact of that drop. And probably
but I don't think that was a drop. It was just, I mean, Dr. Yusuf, if you could correct me, I don't think the MBS is saying there was a drop in inflation. Yeah. I think it was just the data, the parameter that's being used. So it's not like there was a 10% drop or drop in the price.
I agree with you. I mean, so the comparison we are making now, when the man on the street is saying for them inflation feels like 70, meanwhile MBS is saying inflation is under 22 points, that's where the disparity lies. Because how did they get theirs? They did some recalibration and statistical analysis and came down to that. But the impact of that, the people buying gari, for example, or rice on the streets, they haven't really felt a difference in the price they pay for it. So for them, their wallet is highly impacted by that. They haven't seen any gain or any cut down on the expense. So for them, I'll kind of agree with them. Maybe not as much as 70, but it's still, I mean, it's still yet to be seen for the average person on the street. So that's where the disparity is right now, the way I look at it. But
okay, let me
with time, if it permeates the system, people might not be getting the benefit. Like I said again, the gains from the subsidy removal, how are we using it to alleviate the sufferings of people? How do you try to give them some replacement on the cost they're incurring? Some benefit from this.
Let me bring Mr. Laje into this. Mr. Laje, so the perception of the public is that inflation is at about 71%. Our numbers is 22%. What are we missing? Where are we missing it?
Inflation figure was as high as 34%. The Bureau of Statistics feels that we need to change the base year and perhaps change also the methodology. That brought inflation from 34 to 24%. Ever since, we have been seeing relative reduction from that 24%, which was sometimes ago 34%. With all clarity, we cannot say that we had a major drop in inflation, but we can say we have marginal ease in inflation because price is still increasing now at a reducing rate. That's the right way to put it. Now, how people perceive is a different thing entirely. We need to know the population, the sample of the population, central bank interview, and the sample of the population, National Bureau of Statistics interview. When you interview people and people feel that inflation is relatively high for them, we need to be concerned about what is their purchasing pattern. That pattern will tell which basket of commodity they consume. Because when you use consumer price index, you are referring to some basket of commodity. It is not all that is captured by the Bureau of Statistics. We also don't know the one that people consume, so you will not exactly get the same figure. But what I can tell you is that are prices relatively high? Yes, the answer is still very much correct. And people's expectation, perception, is a function of certain expectation. If people are perceiving relative to what happened to them before subsidy was removed, before exchange rates got floated, and also before they start feeling some impact of economy in their lives, they would say it's as high as 70%. But 70% will therefore become even more charitable. But in the real sense of it, for organizations that have tried to vet what Bureau of Statistics was doing before we had the adjustment in base year methodology, most of the reports, the most charitable one among them came back at 45%, which means all the major organizations, and this organization, only one of them is local, most of them are foreign, they saw inflation high as 45% before we had the methodology variation. So what that will mean is that, yes, people have valid opinion, but it also depends on the part of population. But what we know in Nigeria today is that we still have high level of inflation. I think this is what MPC will take into account in considering decision to be taken as we move forward to watch what the decision will be by the Monetary Policy Committee to be headed by the Central Bank Governor himself, Mr. Cardoso. Because 22.2% is high on a rebased inflation figure, what one would expect is that the 15% mentioned by the president would have also been rebased to somewhat around 11-12% if we have rebase the headline inflation from what it was at 84% to 24%. So also, for us to achieve this, it's important for us to start thinking strategically and thinking in terms of coordination as it affects area that is inducing inflation. Food inflation clearly is one. Two, share of money that you asked in your first question with monetary by fiscal authority. But I need to quickly say something. If money to go to capital expenditure, it may not necessarily induce inflation. Several economics journals, sector economics publication has proven that. So long as what is going to
all right, Mr. Laje, Mr. Laje,
production, then it will not necessarily induce inflation.
Sorry, Mr. Laje, we really have to stop you there. The CBN governor is seated and is just about to start. I think he has already started talking. So we'll get back to you. Let's hear the decision.
Of the Central Bank of Nigeria, CBN, held its 301st meeting on July 21st and 22nd, 2025, to review recent economic and financial developments and the outlook. All 12 members of the committee were in attendance. Decision of the MPC. The committee decided to maintain the current monetary policy stance and hold all policy parameters constant as follows. 1. Retain the monetary policy rate, MPR, at 27.50%. 2. maintain the asymmetric corridor around the MPR at plus 500 to minus 100 basis points. 3, retain the cash reserve ratio, CRR, for deposit money banks at 50% and for merchant banks at 16%. And 4, keep the liquidity ratio unchanged at 30%. The decision was premised on the need to sustain the momentum of disinflation and sufficiently contain price pressures. Maintaining the current policy stance will continue to address the existing and emerging inflationary pressure. The MPC will continue to undertake rigorous assessment of economic conditions, price development, and outlook to inform future policy decisions. Considerations. The committee acknowledged the decline in headline inflation in June 2025, the third consecutive month of deceleration. This was largely driven by the moderation in energy prices and stability in the foreign exchange market. Despite these positive developments, members observed the uptick in month-on-month headline inflation, suggesting the persistence of underlying price pressures. The continued global uncertainties associated with the tariff wars and geopolitical tensions could further exacerbate supply chain disruption and exert pressure on the prices of imported items. Members also noted the continued stability in the banking system, evidenced by the stable financial soundness indicators, FSIs, which would further be supported by the ongoing banking recapitalization exercise. The MPC noted that 8 banks have fully met the recapitalization requirements, while others are making progress towards meeting the deadline. The committee thus urged the management of the bank to sustain its oversight of the banking system to ensure continued resilience, safety, and soundness of the financial system. Price and other developments. Headline inflation year-on-year declined to 22.22% in June 2025 from 22.97% in May, primarily driven by the moderation in energy prices, especially cooking gas, wood, charcoal, and diesel. Food inflation year-on-year, however, rose to 21.97% in June 2025 from 21.14% in May, attributed mainly to the increase in the cost of processed food. Core inflation, that is, all items less farm produce and energy also increased to 22.76% in June 2025 from 22.28% in May, reflecting an uptick in the cost of information and communication, housing and utilities, and personal care and social services. On a month-on-month basis, headline inflation rose to 1.68% from 1.53%, largely due to increases in the price of services and imported food. The committee acknowledged the efforts of the federal government in improving security and its impact on food production. Members thus urged the government to continue its support towards timely provision of high-yielding seedlings, fertilizers, and other critical inputs for the current farming season. The MPC also noted the sustained stability in the foreign exchange market, accentuated by improved capital flows, earnings from increased crude oil production, rising non-oil exports, and significant reduction in aggregate imports. Real GDP in the first quarter of 2025 grew by 3.13% compared with 2.27 and 3.38% in the corresponding and preceding quarters of 2024, respectively. In addition, recent data on the Purchasing Managers Index indicates that the Nigerian economy remains on an expansionary path. The external sector also remains stable and resilient, despite persisting uncertainties in the global macroeconomic environment. Gross external reserves rose to 40.11 billion on July 18, 2025, representing about 9.5 months of import cover for goods. Global developments. Available projections suggest that global output recovery continues at a gradual pace. However, recent developments, especially the persistent tariff war and the geopolitical tensions, may continue to disrupt supply chains and exert upward pressure on the price of imports. Disinflation in the advanced economies has slowed, prompting major central banks to be cautious of upside risks to inflation. In the emerging markets, central banks continue to calibrate monetary policy to their domestic conditions, noting the persistent risks to inflationary pressures. Outlook. Staff projections indicate a further decline in inflation in the coming months, underpinned by the current tight monetary policy stance, stable exchange rate, declining PMS prices, and moderation in food prices as the harvest season approaches. Given the persistent uncertainty in the policy environment and underlying price pressures, monetary policy will need to maintain its current stance until risks to inflation recede sufficiently. The committee remains committed to the bank's price stability mandate and will take appropriate measures to foster stability and confidence in the economy. The next meeting of the committee is scheduled for Monday, 22nd and Tuesday, 23rd of September, 2025. Thank you.
Thank you. That was communique number 158, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Olayemi Kadusu. We'll now take questions from members of the press. State your medium, your name, and ask your question. No multi-pronged questions, please. Thank you.
Good afternoon, Mr. Governor, sir. Good afternoon, Mr. Sarah Achimogu, Channels TV. Recently, the IMF board concluded its Article 4 consultation on Nigeria, where it's calling both the fiscal and the monetary side of the economy of some of its reforms in the last 2 years. Would like to know what your assessment of that is, and then if you have recommendations as well, the findings. Thank you.
Thank you very much, Sarah. And I know that Channels has been covering these matters for many years, way before I came into this seat. But for the benefit of our viewers, I think it may be important to say something about why the Article 4 of the IMF is important. Article 4 is important because you find the IMF is considered a credible institution. And whatever the IMF says, what it comes out with, potential investors are interested. Many take a cue from that in making their decisions. And by the way, let me not restrict it to the IMF alone. There are other institutions that on a regular basis, perhaps you may argue not as rigorously and in depth as the IMF would do, but there are other institutions that do similar things. For example, you hear regularly of the rating agencies. The last one that did something on Nigeria, to the best of my knowledge, is Moody's. And they really had stayed away from looking at this for a while. So they did do their own review on Nigeria, and very happily they gave us an upgrade, which is in line with what others have been doing. Again, to re-emphasize, these are the things that potential investors take a cue from. Very important to them. Now, I would say that the findings of these institutions are really not dissimilar. They are not dissimilar. There's a feeling that the Nigerian authorities have taken bold, transformative measures to help to properly reposition the macroeconomic fundamentals of the country. There's the general feeling that they've moved, and you talk about the monetary side in particular, we've moved towards the monetization, the discontinuation of the monetization of fiscal deficits. The foreign exchange market is working a lot better and more smoothly, with the result of which it has encouraged inflows into that market. Of course, reference is constantly being made to the fact that Nigeria has moved away from the very difficult situation where there were subsidies on the foreign exchange and, I beg your pardon, on the fuel subsidies, on the fuel side. And of course, reference is made to the fact that these measures, painful though they may be, have resulted in stability in the foreign exchange market. There's positivity with our trade surplus, and it has restored investor confidence. So I think those are all things that have been able to demonstrate, okay, across the board, not just with the IMF, right, across the board, that the policies that we have embarked upon are bringing out results, and that inflation is gradually coming under greater control, and very importantly, Nigerians are having greater confidence in their own currency. I was quite struck in having a discussion with somebody just yesterday, and he showed me a dialogue that he had with his travel agent, where he was owing the travel agent some money, and the travel agent said, please, I know you normally give me my money in dollars, but I'm very happy to take it in naira. Those are the things that are happening across the board. You all, as members of the press, have been covering these activities for a very long time. A lot of what you see going on now is transformational, and they are here to stay. The differences that we had between the parallel market rate and the official rate, you can all see it yourselves. Some of the banks are now allowing you to use your Naira cards when you travel. Those things are here to stay. They are not a short-term measure. They are here to stay. And as I said, as more and more of vigilance, transparency, rebuilding trust, I'm very, very confident that we can only but have an improvement in the positive signals that we have seen coming out, and that the IMF and others are also noting. You spoke about recommendations, and yes, there are recommendations, okay, for us to, of course, build more resilience. In other words, you may be here today, but you have to ensure that you are building sufficient buffers for uncertainties into the future. There's also the recommendation to ensure that you stay the course, that you do not start something that you cannot finish. And of course, we will not do that. And I know many of you have heard me say that several. We will not do that. We will ensure that that collaboration that is necessary to reduce uncertainty, because let's face it, nobody likes to invest in places where there's potential to lose money. They come in where the environment is enabling. And we have to be consistent in all our policy thrusts and all the things we do to give the confidence to the outside investing public and, of course, to Nigerians as well.
Good afternoon, Mr. Governor, and members of the MPC. I am Nancy, Nigerian convoy Nancy of PNC. My question to you, Governor, is around the year-on-year headline inflation, which you referenced earlier, easing marginally from about 2.97% to 2.02% in June. However, we're seeing that month-on-month, which you also acknowledged, accelerated to 1.68% from 1.53%, suggesting that there's still that persisting underlying price pressures. So my question now is, how is the central bank recalibrating its monetary policy toolkit to ensure that the disinflation trend that we're seeing is not just statistical, but structurally sustained? Thank you, Governor.
Thank you, and it's a good question. Let me first start off by saying that at the central bank, we recognize that our policy toolkit is working, therefore, inflation is coming down. However, we also recognize that our goal is to ensure that we get to single-digit inflation. So much as it is coming down, we're still determined to ensure that we bring it down to single digit. So I want to say that up front. Let us also remind ourselves a little bit about where we're coming from, because I think it's very important to put the proper context and for us to understand where we're coming from, that will give a good view, a better view of where we're going to. We are coming from a situation of enormous money supply. Enormous money supply. And I've spoken about this in different fora. I've spoken about the huge injections that went into our economy from ways and means, unprecedented and probably difficult to find any other place to compare it with. I've also spoken about the huge intervention injections that went into our economy and still, quite frankly, are with us. Those things are of such a proportion that they just simply do not disappear overnight. So those are some of the challenges that we have to cope with. And that is why our response to this is that we are, of course, operating a very tight monetary situation. We have absolutely no choice but to do that. It's at a cost, but it needs to be done. If we are going to achieve the single-digit inflation rate I spoke about earlier, these are part of the measures. In addition to that, I want to say that there are upsides and positives that will complement the work of the central bank. For example, we are aware that for a while there have been issues with respect to revenue coming in from the oil and gas side. Now there are very, very positive shoots coming out on that. We see that the NMPC has, for the first time since January of this year, has published the fact, we've been made aware of the fact that we are meeting our OPEC quota. That's very good news. It's very good news. And it all adds to the very, very, very positive trajectory ahead. Of course, there's also greater transparency with respect to NMPC and its earnings, and of course it coming in to its account and to the monetary authorities. I saw something on television just before I came in here where they were publishing their monthly profits. That's also very encouraging. It's very encouraging. So I think some of these areas will basically help to bring down the inflation that we are talking about. We are also ensuring that the handshake that is supposed to take place between the fiscal and monetary side, which is very, very, very important, the close coordination that needs to take place between the two is going to continue. And I was privileged again to have been called on to address the NMPC's first retreat, in which we had very, very useful discussions, and which I believe show for greater collaboration as we go along. We will continue to use our tools, the MPR, the CRR, ensuring that the foreign exchange market works efficiently. We are going to continue to do that, and you can rely on us for that. And of course, the inflation expectations, we will manage them in such a way that we are as transparent and open as possible, so that people understand, the various publics understand where we are heading to. But in summary, we are determined to ensure that we use all the different tools at our disposal to bring down inflation to single-digit levels.
Good afternoon, Mr. Governor. My name is Aviation.
And so that's it. Journalists asking questions after that announcement by the CBN governor. And just for emphasis, it's a hold decision for after the meeting. MPR is still at 27.5%. The asymmetric corridor is between plus 500 and minus 100 basis points. The CRR is 50% and liquidity ratio is 30%. So it's a whole. Mr. Kuku, is this what you're expecting?
For inflation, I feel it will be too early to start to celebrate and declare victory over inflation. So I think things like you said, there's still some things to consider, i.e. Food inflation segment month on month went up, and also for core inflation. So we haven't really stabilized on the inflation front. So I think the next meeting might afford us some time to consider and maybe try to cut. Then it's going to be harvest season. Instead, there will be stability around FX, and also so there won't be some imported inflation segment, and also crude prices will be more stable. So I think that might be a perfect timing to decide to just ease the foot on the accelerator and just probably start with a small cut. So it is in line with my expectation, actually.
You too, Dr. Yusuf?
Yes, I was expecting a hold, actually. So what the CBN had, the decision, of course, resonates very well with me. But what we cannot stop emphasizing is the fact that the monetary policy alone cannot tackle inflation effectively. Of course, there is a cost to it, this tightening, because those who are taking credit to fund their business, it's a lot of pressure on them as we speak since the regime of this tightening. We understand where the CBN governor is coming from. You can only use the tools you have, to solve the problem that you want to solve. But we should emphasize the need for complementary policies, from the trade policy side. Because he talked about supply chains, although he was emphasizing more of external factors in the supply chain. But we also have domestic supply chain issues. That is the cost at which you get your inputs, from the ports to the factory. The fees you pay, the duties. Some of these duties we need to begin to look at how we can bring down those costs. I'm not talking about importation of consumer products or finished goods. I'm talking about easing the supply chain pressures for those who are in production across all sectors, so that the cost of production, the cost of rendering services can also come down significantly. And of course, he talked about the issue of, this handshake between the fiscal and monetary. Well, we have been talking about this handshake forever. We hope that it will begin to take root properly. And
I think he says it's already started, that they're going to maintain
They are going to maintain it, yes. But again, he also expressed concern about liquidity effect of FAC, on FX and the macroeconomic environment. I think we need a lot of work, to be done on that. We need a framework to ring-fence this FAC, to ensure that it doesn't filter into the larger, especially to FX, in a way that will be creating challenges for the FX market. I think that is very, very important.
I wonder who is going to create that ring.
No, I mean, it's an economic policy management issue. Because
I think it will require a sit-down and proper planning by both authorities.
By both authorities, those in charge of, those who are the managers of the economy. Because it's a major threat to macroeconomic stability. Yes, we want more revenue. We have been clamoring for more revenue. But if more revenue is now creating problems, for the economy, then we have to sit down and look at what will work, to ensure that the increase in revenue doesn't pose a threat to macroeconomic stability.
What are the possible solutions to that? Because, I mean, he expressed this even before the meeting. We talked about it, before we went on, and he has brought it up again. What are the possible scenarios that could deal with this?
Well, there has to be engagement across all levels. This is a federation. Because the state government can claim that it is their money, they can spend it the way they like. But if we know that this is a common macroeconomic objective that we want to achieve, they can sit down and look at how do we manage our fiscals at all levels to ensure that we don't have this kind of threat. So you bring technocrats to the room, you bring the politicians to the room, and lay it on the table that we need to achieve this macroeconomic objective. I'm sure there should be a way out of this. There should be a way out. But it has to be something that is participatory, something that is inclusive, because of the nature, of all these fiscal operations.
You wanted to say something?
Yeah. I think also as a CBN, while also agreeing what you said, there must be dialogue. But again, there are some other things I think they can introduce. Something like FAC, maybe the disbursement should not be as once. It shouldn't be like a bulk disbursement. You can face the disbursement. That's also subject to what the governors will say. You can do that. Also, another thing to consider could be that they can actually give them instruments that can be discounted, rather than give them the actual cash. So as they need it, they can bring that instrument even to banks. They can get to discount it for them or through the CBN. So that might reduce the bulk impact of having that liquidity just come into the system at home. That's something we can also look at. There are instances where they even give security sometimes, such that you can then discount those things to get immediate cash when you need them. So that bulk impact of the lot of 1.something trillion coming at once or so, you can reduce it. I just think CBN can also look at today.
All right, so some ideas there. Mr. Abgaje, I believe you're still there. Is this in line with your expectation, the whole position?
100% in line with what I expect. If you look at the economy and what is expected, Central Bank had indicated before now that you need to see the trend of starting measure, and the expectation is to go below 15% before we can see some adjustment. But I also think that even if the Central Bank wants to express some optimism, it might wait for inflation to go below 20%. before we see any form of adjustment. What we know is that except and unless we see some externalities that has huge pressure on the economy, we might not see a further increase. What we are likely to see in the medium term will be for rate to continue to be held or for a marginal reduction in one of the parameters. What we have seen today is the MPR remain at over 27%. As a credit corridor, it also within plus 500 basis point to minus 100 basis point, and that has a lot of implications. Central Bank is saying no to high yield fund. If you come to us, you are going to do 5% for borrowing and also minus 1% for deposit. So that has implications seriously. I also think that in light of what has been said before the meeting and what is now the decision, it means that yes, cost of borrowing in Nigeria will still be relatively high, and that has implication because we are not yet an advanced economy. In an economy where you cut credits simply because you want to manage inflation, the effect might not be as dire as we have. The reason is because this economy rely largely on liquidity. If you look at money supply, you will see relative surge in money supply, and it's quite high. So an economy that is really cash driven, it's important for us to start looking at alternative, because the real driver of inflation in such economy will definitely not just be monetary nature. It also has fiscal and trade. We have their influence. So as much as we are seeing central bank doing best possible to tame this inflation, they are only responsible for by only 50 or 55%. If you must apportion what is responsible to them, then you know that fiscal authority, which of course PAC is included, pattern of spending by subnational and the federal government, as well as local government, it's included. Electionary process, even though we don't have it now, which will be happening in a matter of months. And I'm saying this up front so that when the effects start happening, we don't wonder what is happening. Is included. And our ability to wrap up with export is also included. All of those perhaps are beyond what the Central Bank Governor and the Monetary Policy Committee today can do. They might act as advisory to government at various levels so that their work might not be as difficult. For now, it is what it is. The rate have been sustained. Cost of borrowing remains high. We might have some level of crowd-out effect in terms of job creation or employment, but we wait to see how the impact turn out in the next 2 months. As Central Bank Governor have said that by September, we'll be here again to see what inflation is saying, and that, of course, will inform what the new decision will be.
And you know, the central bank governor is also very emphatic about this target of a single-digit inflation number. How soon do you think we can get there? Looking at 22.2%.
The last time we had single-digit inflation was in 2015. 10 years after 2015, we've not been able to return to single digits. What are the implications? First, when President Buhari got to office, we saw oil crisis. After that, President Buhari and his team committed own goal by closing the border without providing alternative. After that, we saw negative externality in the name of COVID-19. When that met the impact of border closure, we now saw Putin and Ukraine, Zelensky, have their crisis. Then we saw some currencies upside down, or currency crisis in Nigeria that led to some level of surge in exchange rates. Then we saw policy of subsidy removal. We saw policy of flotation. So all of these are accumulated into what we experience. How soon can we reverse some of the economic concerns or economic quagmire, which is not limited to ways and means of trillions of naira that was pumped into the economy? I tell you, that will still take some time. My projection is perhaps Q2 2026 before you can be looking at Q1 to Q2 2026 before you can be looking at single digits. Other things being equal, which economic cause ceteris paribus, not all things, other things being equal. But at that time, my major fear, which I've mentioned about 2 or 3 times on this show, is political activity will happen. And that is my worry. Will Nigeria have that single digits inflation in this dispensation or under this administration? Because when you check our GDP, over 80% of the time, pre-election here, is when we have major surge in inflation and especially in our GDP growth rate. So we need to really pay close attention to that so that what we are pursuing may not be what is actually pursuing us in the coming period.
Mr. Agbaje, thank you for that. Dr. Yusuf, so we are talking of FAC on the one hand, and Mr. Agbaje keeps reminding us, so while we are projecting or looking forward to a single-digit inflation, that might even be more difficult in the coming days because political spending is going to also feed into inflation, not just FAC at that time.
Well, the irony about political spending is that sometimes they're even dollar-based. So we're even likely to see more dollars floating around during the electoral periods. That's also a possibility, because I do know that for the politicians, because dollar, of course, is portable, and when it comes to spending, I mean, we all knew what happened during the primaries. Nobody was carrying naira around. It was dollar that people were spending. Of course, we need to worry about all this kind of spending going forward. But what is more important is to ensure that the totality of the fiscal operations are kept in check. Issues of debt, issues of fiscal deficit, those things are very critical, so that we are able to keep tab on critical monetary variables. Money supply growth, all those things are very fundamental to ensure that we keep the temperature of the economy as low as possible. And of course, we are doing well with our FX, the stability and all of that, and the confidence and the inflows, both from the autonomous sources, from the portfolio sources and so on, even from non-oil exports. Those inflows are coming. And just as the CBN governor said, even in terms of oil production, those things are, so these fundamentals are likely to see us through, as long as we ensure that we manage the fiscals properly, fundamentally, so that we don't, allow the economy to overheat. I think that is what we should be looking at.
Mr. Kuku, how soon do you see a single-digit inflation in Nigeria?
Okay, my thought around that, maybe I share a slightly different view. To get to a single-digit inflation, it calls for a lot. And why do I say that? Which is that borrowing, by its nature, is inflationary. What I mean by that is, Nigeria, for example, now we have a bond value of about 30 trillion. The average coupon we are paying is 15.7. Every year, that means you are creating about 4.8 trillion to the economy. What happens to this liquidity? Is either that's free cash flow, that's also going to chase some commodities and here have you, except, and the only other option you have to mop it up is either to issue OMO bills and all of those things. If you don't do that, you've already created liquidity that would then kind of inject some pressure on inflation. Secondly is, even the current OMO bills we have now running, have about maybe 10 trillion maturity in before the end of the year. If those things mature, the design of our OMO is more for FPI related, is either they want to exit. If that exit comes, that's pressure on FX, on buy FX. And FX also, as it increases, it also feeds into inflation. So we are kind of in a spiral, or I'll say so we need to, saying single digits is going to call for a lot of discipline, or maybe I'll say financial prudence or fiscal prudence on their side.
But we've seen the FG's appetite for borrowing reduce, at least for the third quarter, I believe, compared to the earlier quarters of this year.
Okay, that's what we need to see. I think maybe with the tax reforms and all of that, we can have more in the coffers in terms of revenue to reduce the borrowing. But as long as we go on that borrowing spree, then we put in a lot of pressure on inflation.
All right, Dr. Yusuf, he just talked about the tax reform.
Yeah.
Where does that fit into this target of a single-digit inflation, and Mr. Cardoso, quite optimistic that there will be moderation in food prices, PMS prices. We don't know what can happen, Israel and all of that tomorrow, but he seems quite optimistic, and all of this will lead us to this single-digit inflation. But then we have the tax reform, which, as you noted earlier, is going to bring more revenue to the government. Where do we fit in that?
No, the beauty of the tax reform is that it may help to reduce the deficit, because it is deficit that triggers all this borrowing that he alluded to. So if you have a significant improvement in revenue, rather than blow up the expenditure, we should be aiming to reduce our deficit. So if we have a reduction in deficit, then there will be less pressure to borrow, and therefore there will be less hit on the economy in terms of inflationary spending. Because one of the key things that have been fueling this inflation is also this borrowing. Because if you look at the ratios, I believe for last year it wasn't so good, particularly because most of our revenue projections were not met, especially from the oil sector. You know, revenue performance in the oil sector was just about 50% or even less. So that led to a very high percentage of debt service to revenue. And we don't want to see that growing. So the tax reform is likely to boost revenue. If it boosts revenue, it's likely to reduce deficit. If it reduces deficit, it will reduce borrowing. If you have less borrowing, you are likely to see less pressure in terms of increase in money supply. I think that is the nexus that we are looking forward to. But beyond that, because it's also important to look at what resonates with the ordinary citizens. It's very important. What we are talking about macro data, GDP, FX, and all of that. What happens to the price of noodles, the price of bread, the price of cooking gas, the price of tomato? Those things are also very important. They are important for social reasons. They are also important for political reasons. You know, so as we have this conversation around the economy, we should also have an eye. We should have our eye on how to moderate those prices in the marketplace. Because, again, we cannot overstress it. The only way you can convince the average person that the economy is doing well is that if he goes to the market, the price of rice is coming down, the price of bread has dropped, the price of noodles has dropped, the price of cooking gas. That is when it will make meaning. So that particular consideration, I think we should hold it very high in our agenda within the framework of economic management. That is very, very important.
So what do you say? Because I've had this conversation of the missing link between the macro and the micro. So we see the macro looking good, the data, inflation is declining, GDP and all of that. But when you look at the micro, it's not looking so good. And one of the conversations I had, I remember my guest then talked about the social nets programs, that could be a connecting factor.
No, you see, my view is that we should have targeted policies on all these items. You know, the conversation so far is at the macro level. But when you want to tackle specific basic needs, you have to take specific targeted policies. I mean, look at what happened when the president approved a waiver on importation of rice, for instance. When he approved waiver for pharmaceutical products, tax and all of that. Even though it wasn't so popular with rice producers, but it brought down the price, the cost of rice. You know, from what was going to around 100,000, it came to 70, in some cases even around 60-something. You know, so the point I'm making is that we should identify these items. We should identify those who are producers in that sector. We should have an engagement with them that this is the objective of government, and it's a very important social objective. We want to bring down this cost. What kind of incentives can we give you? You know, so that we can, you know, deploy or activate our policies, monetary policies, credit policies. Luckily, we now have some capitalization for the Bank of Agriculture. We should have our tariff policy targeting all of these things. We should even have our tax policy. Already we have a tax reform. If we need to give some tax incentives to achieve that objective, we should do so. So the important thing is to activate all the key policy instruments to tackle this problem of basic needs. cost of living is extremely very important. So that will be my approach to it. All these conditional cash transfer and all of these that the World Bank often say, those things don't achieve much in this kind of environment. Because first, we don't have the data. Second, we don't have that institutional capacity and discipline to ensure that we deploy those kind of resources properly. So it has to be a policy-driven approach. That, for me, that way we can achieve, I think, a lot more results, in bringing down the cost of living.
All right, as we wind down now, let me get parting thoughts from Mr. Agbaje, how we can close the gap between the macro and the micro. Impressive looking macro, at least looking that way, but that has not translated to the micro.
Yes, so closing the gap between the micro and the macro is very, very essential. It's to come out from the policy side. What we have seen most of the time is that some of the decision government have taken, macroeconomic decision, it has not reflected in the life of in business and also in house, that some of the policy made by government is meant for them. And why that? The reason for that is because parameters for measurement are missing. We are not perhaps checking if some of these policy will have direct impact, and if it will, when will this impact be? Apart from that, what is the sustainability of this impact in the life of people? It's important to know that when we talk of macroeconomic policy, we are talking in terms of aggregate. We are talking of government as a component. We are talking of household or firm as a component. And we are talking, household or businesses or investment, as the case may be, as a component. And we are talking of household, which is the last component. So consumption for household, investment of firms, and government. So most of the time when government see results in one of the components, which is government, we think we have achieved macroeconomic variable and it has impacted on micro. The answer is no. So we need to wait to see the impact on all economic components, which includes government, firm, and household. So because we are not waiting and the policy thought is not expanded enough to capture the remaining two components. That is why we are not even having sufficient investment in the first place. Because of course, when you look at the question in sense of why are we not attracting investment, which of course will help to build the economy, to engage household, for businesses to expand, and for government to have also revenue in its cover. It is because the third have gone towards it. We have not considered all downsides or upsides to some of the policies that have been made over the years.
All right, let me end with you, Mr. Kuku. How do we close this gap? Or let me even start by asking you, are the macroeconomic data, are they impressive from your perspective?
No, the macro data that we've seen so far impressive. A lot.
All right.
We didn't even speak about the rebased GDP. As now making the debt to GDP look very, very, very nice. So clearly the macro data have been very impressive. We're talking about taking it to the micro segment. Yeah, there's a delay in the transmission of the benefits, really. There's a delay. But what I think we can do, which is, I'll still go back to the point on if currencies have moved from 900 to 1.5, there's no doubt prices have moved already. Especially when you have an economy that is largely import dependent. That shows that. But how can you compensate people for bearing that kind of a huge burden? What is said about IMF saying 5,000 payouts, that might not work. But again, what we need to also have is, we need to have a free market. Markets usually correct price when it tries to create a balance between the demand and supply. So as governments, you need to put in all of the parameters that will make markets work efficiently. So you can put that in place, you will see that the stakeholders or the stakeholders in that market will operate and always arrive at the best price. So what we can do right now is to put that, it might take a while because we don't have things like infrastructure, which will enable this kind of opportunity. But I would say that with time, if we continue on this trajectory, I think we might be able to deliver some of the dividends to the micro space, which is delayed now. It will be delayed, but with time, with sincerity of purpose, I think at some point we should be able to deliver some of the benefits of macro to the micro segments.
Okay, I think you're supporting Mr. Agbaje when he says, Alaje when he says that all other things, because you talked about sincerity of purpose and every other all other things being equal.
Bring in the subnationals too. They have very, very critical role to play. The state governments, the local governments, they're even closer to the people. So when we are having this micro impacts conversation, they have to feature very prominently. While the government is tackling the macro issues, they also have roles to play in making sure that there's a trickle-down effect
to the micro. All right, I need to thank you so much, gentlemen, for your time. Dr. Muda Yusuf, Chief Executive Officer, Center for Promotion of Private Enterprises, thank you so much. Mr. Jamiu Kuku, Treasurer at FSDH Merchant Bank Limited, thank you so much. And also joining us virtually, Mr. Paul Alaje, Chief Economist, SPM Professionals. Really appreciate your time and your views on the program today.
So much. Thank you.
All right, so that's it. It's been a Business Incorporated special. We head there. It's another hold for all of the parameters that will determine the direction of funding in the country until September. This is what we'll have to work with. But here on Business Morning and Business Incorporated, we'll dissect it in the coming days. You don't want to miss tomorrow morning, 10 a.m. You get more about the impacts and expectations from all of this. I'm Ini John Mekwa, wishing you the best of the rest of your day. I'll see you tomorrow, God's grace.